funding has become a major problem for businesses. Well, not just for businesses, for families, but because this is a business show, we're dwelling on businesses. So funding and finding financing for businesses has become a very big problem in this climate, right? Mm-hmm. So we want to ask you, Mr. Joshua, what do banks bring to bear to solve this problem?
Okay, thank you very much. By virtue of the definition of banks, banks are financial intermediaries. They midwife the flow of funds or funding from areas of deficit, or from areas of surplus to areas of deficit.
Okay.
Now, areas of surplus to areas of deficit doesn't necessarily mean that areas of deficit don't have funding. The point is that they need more money to produce better, to produce more. In fact, how the banks make their money, what they do is identify successful businesses, partner with them by funding the business, and then the increased profit that is made is now shared between the bank and the business by virtue of the interest that is charged. You understand that? Yeah. So that is just it. So you could have a very large business that needs more money for expansion, and then you have individuals that are putting their money in the bank to deposit and save. Now, the large business on its own already has much more money than the individuals, but because there's like a crowdfunding or the critical mass have paid into the banks and they are awash with cash, with deposits, they can redirect some of that to funding the large institution that can utilize the funds for expansion and for increased production and ultimately for the good of society. Really. So that is basically the role of banks, to midwife the flow of funding from surplus areas to deficit areas.
Right. I hear you, right? But as a mediator and as a mentor, right? I mentor a lot of businesses. As a matter of fact, I have a platform that has about 250 businesses and CEOs under my tutelage. You know, it's either I'm teaching export or I'm teaching, different aspects of business. What we hear all the time, and I know it's true from my experience as a businessman, is that banks, you actually mentioned that right a few seconds ago, banks don't give funding to people who actually need them. They rather give them to people who really don't need them. And that's why we find banks going to see all these big shots and asking them, hey, come, we'll give you first. And he'll be saying, I don't need it. We have enough funds. Yeah, the banks keep pushing. Now, our business community would wish that you guys will push to give funding to businesses that actually need it. What you say about that?
Okay, thank you very much. Now, banks don't. There's this English saying that the banks give you an umbrella when the sun is shining. They take it away when the rain is falling. That is a misunderstanding of what banks do, really. Why are banks around and why are they even profitable? The truth is this: if I earn 100,000 every month, I want to buy property worth 5 million naira. So I don't have that cash to buy 5 million naira, but it is certain that I'm earning 100,000 every month. The bank would prefer to give someone like me the money to pay and then pay them over time with interest than someone who doesn't have anything at all.
I understand that because there's an existence of cash flow, right?
Exactly. There's cash flow. And if you are hoping, that's why you see banks don't lend to startups. You have to be at least 3 years. Because the rate of default, the rate of businesses failing, even in the US, is so high that except you're a venture capitalist or something, you may not find a regular financial institution lending to you. But as long as the bank has seen your efforts in it, they will also try to come in. You have to have shown some expertise by making money in your field of business for banks to come in.
Good point. So I forgive you right there.
Thank you very much.
All right. So what kind of facilities are available for businesses? Let's start with your bank, but you can also tell us generally. Yes.
Okay. So I'm going to be general. Because truth is, I think I represent
the banking sector.
Banks here. So
that's right.
Whatever is the wrong notion needs to be corrected, or at least. So you see, the thing is this: They are what we are guided by, and we call risk acceptance criteria. If the business entity or the individual meets the risk acceptance criteria, then the general risk acceptance criteria, but then the banks now domesticate them to see what suits their own particular scenarios, their own conditions. You could have a large bank that could have focus. They are what they call sectors of lending, and if for banks the particular sector has been overutilized, maybe you have over 100% in that sector, they may not want to lend to that to businesses in that sector anymore. So you may find the bank saying, okay, being shy of lending to a particular sector is simply because that sector, for instance, telecoms or agriculture, it doesn't. I'm just being random.
Yeah.
But another bank, another deposit money bank could also say, no, we are coming up in this sphere and we would like to do that. A very good example that fintechs who have run away with this online lending and all that. While the traditional banks are still watching it and gradually understanding how to still be profitable in it, and then coming into play in a much larger way.
Yeah.
So I think that is it. We have risk acceptance criteria and we can lend to anybody. The truth is, banks just want to see efforts. They want to see that you're doing something. They want to see that when they look at your books, there's some money you're making by the side.
Yeah.
Okay. They are what we call the 5 C's of lending. That summarizes everything that banks do when we want to expose ourselves to a customer. Okay? Because we call facilities exposures.
Yeah.
It means that we expose ourselves to you.
That's right.
The first and most important, and probably 90% of what banks look at is your character. We may not be up to 90, but that is the main thing. Character. With a good character is mainly defined by, how well you have used funding that has been extended to you in the past. The past is a predictor of the future. So, did you do well when we give you money? If you were excellent, you paid down without a day of default. There's what's called the CBD, Credit Bureau Desk.
Yeah.
Credit Bureau portal that all banks subscribe to.
Okay.
So they go there to check individuals and companies. And if you've done well in the past, they give you.
The record will be there.
Yeah, the records will be there.
Yeah.
If you have a return check, then it will flag so that it will now be a decision by the bank whether to still go ahead, to go out on a limb. But the thing is, if your character is impeccable, you will find yourself being categorized as blue chip. So that's why you find some companies called blue chip. With those ones, we don't even need we don't need security to lend to them.
Yes.
Without even wanting to say I'm advertising anybody. Dangote, for instance, is our local blue chip. He may be in some murky waters now, but
it's everybody's bank's dream.
Yeah, exactly. because of how he has performed in the past.
That's right.
And the name he has. So then there's also the capacity. Capacity is how much turnover, what you can actually
carry.
What you have done in the past, and how well you can handle it. And capital is also what is your own. What do you are coming to the bank? What are you already working with? How much is your capital? Banks usually would lend a percentage of the capital you already have to you.
Yes.
Okay. Then collateral is the security that you are offering to cover the loan you're going to collect.
Yeah.
The security, and security could be in any form. The most liquid is cash. So if you can cash back your loan, that will be the best. Or it could be by a fixed immovable property. So by mortgage, legal mortgage, so it's called. Then of course the last is the conditions. Conditions are, for instance, an African country the conditions in an African country may not be as suitable to work in as the conditions in a very stable, Western country. So that's just on maybe conditions, maybe the northeast and conditions in Lagos. Where would you rather want to lend to a company operating in? So that summarizes what conditions are.
Okay. So you just talked about, what qualities. Actually, that was going to be the following question. But it's good that you talked about it. What qualities a business could possess, to qualify, for a facility or a loan, right?
Yes, Having said that, I also want to mention that the amount will also be determined by each of these.
Yes.
By each of these. If lending to you is a higher risk than lending to someone, then the amount will be reduced and the interest increased. Okay. So that whatever happens, the bank can cut their losses.
Okay.
But for someone who is very stable and over time has built a very strong reputation for himself, he can definitely get the best from banks.
I see.
Banks will fall over themselves to give him, and there will even be rate wars, for that. But that's just because individually or as a body corporate, he has done quite well.
Okay. Great. Chemaka, do you have some questions?
Okay. What I want to ask is in terms of repayments, assuming that someone finally gets this loan, for the businesses that are just startup businesses, is there a special interest rate for them or a special repayment bank? Because this also something that usually scare them away. When you mention, why don't you go and obtain loan from the bank? They're like, I don't have stress for bank while and all of that.
Okay, so I'd address that. It's now of utmost importance to give the prospective borrower his repayment schedule. So the borrower knows ab initio how much he's going to pay back, how much he's going to pay for each month or for each week or for each quarter, depending on the arrangements, And there are even kinds of loans that are called overdrafts, where you can overdraw on your account. Okay, so the thing is this, and we must understand that just like if you had $1 million naira, and then because you have a good friend, the good friend is not doing much, it's not doing anything, has not done well with all that he has tried to do. And he now comes and meets you and says, give me $1 million naira and I will pay back in a year's time. But the guy
it's not dependable.
It's not dependable.
Okay.
That's on the one hand. Then you have another guy who has been eking out a living, has been doing everything possible, has no ego, makes no bones about getting his hands dirty and doing something, and you see him over time improving in his net worth over time from 100,000. His business is now 120,000. He's now 150, now 250. Even you will say, guy, can I partner with you? If I give you 100,000 to add to this, what are you making on your capital already, your existing capital already? He says, okay, I'm turning over 200,000 every month and I'm making 30,000 profits. If you give me another 100,000, I will now make 45,000 as profit because I will now have 300,000. So that will be 15,000 extra. And I give you 10,000 every month. I keep 5,000 because I am the one doing the business. You're the one that has the funds. And you agree and you go into a partnership with him. And he dutifully pays you your 10,000 every month. The other person may be more beautiful. The other person may be more appealing. The other person may be, I don't know, maybe a better orator. But it comes down to what the person has returned every month. Okay? And that determines his character, and that determines what we will get.